What's up, everybody? My name is Joe Brown, and this is Heresy Financial. As the situation in China with Evergrande unfolds, investors everywhere are paying close attention to see if this is a BTFD moment or a GTFO moment. So in this video, we are going to talk about a few of the recent developments that are key to watch going forward. Some of them are big risks, big concerns to be watching, and a few of them are potential reassurances to any investors that are looking for bullish news. Ready? Let's dive in. All right, so on Monday, Evergrande had some interest payments due on their loans, and they have a one-day grace period. So as of the time I'm recording this, not sure if they got paid yet. They have more interest payments due on Thursday, totaling $119.5 million worth of interest. And apparently, Chinese authorities have already told lenders not to expect any repayment. Additionally, Asian markets are closed due to a holiday, and that has potentially contributed to more volatility because you have less potential buyers stepping in to buy the dip, but also you have less potential sellers. So it's unknown whether or not that's contributed to some of the sell-off that we've seen over the last day or so. So here's what it looks like at this point. There is no bailout coming to Evergrande. At this point, it still looks like they are going to be allowed to fail if that's what it comes to. Now, another point that needs to be made, because many people miss this, it is not an issue with US dollar denominated debt. Evergrande has about $18 billion worth of US dollar denominated debt of, 300 billion or so in liabilities. And so it is not an issue with just not being able to get your hands on dollars because, China can't print dollars. So that's not an issue here. Now, at this point, it is still unknown who has exposure to that total pool of liabilities that Evergrande is probably going to be defaulting on. But one thing we do know for sure at this point is that the most likely candidate for the major risks, the major contagion, is going to be through property liquidations. We will almost certainly see massive downward pressure for a long time on real estate across the country. This is going to hurt anybody with exposure to real estate, and in China, that means everybody. This means that banks are at risk because of the Evergrande situation, but not directly because of their overexposure to liabilities from Evergrande. It really just means that everybody is exposed to the downward spiral that real estate is going to start facing. In fact, analysts estimate that a 20% decline in real estate activity would result in a cumulative loss of 5 to 10% of economic output, and that's assuming there's no financial crisis. And given how reliant the economy is on the growth of real estate, the leverage in the system, not just with Evergrande, but everybody, a 20% drop in real estate activity is totally likely here, and a 5 to 10% drop in GDP is probably conservative, especially given the CCP's recent propensity to push the painful results of free markets on the country right now as they're trying to rein in moral hazard and decrease leverage across their country. The next risk comes with consumers, as consumers are highly dependent on the wealth effect in order to continue increasing their spending, and a downward spiral in real estate prices, number one, it's already started, but would continue to impact spending in China. And in a leveraged economy, a stall in spending is very dangerous. So this highlights the real contagion, that it's most likely not a risk of one bank having, a bunch of bad assets that they can't collect, and so they can't pay on, and you have a domino effect of banks knocking each other over. That's likely not going to be the result of this. That's likely not where the contagion or how that's going to spread. The real risk is just a collapse in total economic activity in China. You've got like a snowball effect of a reverse wealth effect. You've got liquidation of properties resulting in property values being depressed, which means that other developers, other real estate companies start to experience some of the same things, maybe not to the same extent, but some of the same things as Evergrande. You've got people's total net worth starting to drop. You have savings start to go up. You have both real finished projects go down in value, and then other projects that just never come to a fruition, so that paper wealth evaporates. And so spending can grind to a halt, which as one person's outgo is another person's income. And so spending grinds to a halt, then you also see incomes for companies and other people grind to a halt. So you can have a really, really dangerous death spiral start to unfold here. The next risk we need to be watching is that it wouldn't be unlikely to see a yuan devaluation here to help soften the blow. If we take a look at this chart from Crescat Capital, you can see the tight correlation between Chinese growth stocks and the yuan. And if this correlation holds up up, we should see a won devaluation right around the corner here. And the final risk would be the Federal Reserve. The Federal Reserve is meeting this week to determine and announce whether they are going to be moving forward with tapering their asset purchases. As I'm sure you're aware, right now they buy at least $120 billion worth of assets every single month. That's new money being injected into the economy to help keep asset prices going up to infinity. And then if this week they announced that they were going to be pulling that back on schedule, that would be the perfect storm, as that would happen right at the same time as the world's second biggest economy faces an economic contraction, a broad collapse in asset prices, and their consumer spending grinds to a halt. Okay, so those are the risks to be watching. What about the bullish news? And I don't say good news because I guess it depends on your view on whether intervention and manipulation and asset purchases and easy money are good things or bad things, but let's just say bullish news. As I alluded to earlier, this is not a Lehman Brothers type of event. As far as we can tell right now, there's almost no risk of this cascading into bank failures as a result of direct exposure to Evergrande's liabilities. Lehman Brothers was more of an issue of bad collateral in the system, and everybody had this bad collateral. And as soon as somebody stopped accepting it, a company like Lehman Brothers, that's all they had, so they couldn't get their hands on overnight funding, and they are insolvent overnight. It doesn't seem like any risk like this exists. I could be wrong, we could learn new information, but right now that doesn't seem to be the risk. Further, Evergrande is smaller both in percentage terms and in absolute terms than Lehman was to GDP of its country. All right, and the second piece of bullish news is that Contagion is already being priced in. Now, you're probably wondering, wait a second, how is that good news? Well, if Evergrande right now was trading at all-time highs, that would be terrifying. That would be horrible news. Just like mortgage-backed securities right before the great financial crisis really hit, they were trading at full value as if there was nothing wrong with them when they should have been trading at pennies on the dollar. And it isn't just Evergrande stock that has taken a hit, it's everything. You've got Chinese markets broadly, especially anything related to property or high-yield debt, have just been getting hammered. Look at Henderson Land Development. Look at Ping An Insurance, who just recently announced they have zero exposure. Doesn't matter, they've still gotten hit hard. Look at the Hang Seng Index. So it might be counterintuitive, but this is actually great news. It means that asset prices are freely pricing in the potential new reality. That potential new reality includes economic contraction, lower consumer spending, default risk, etc. It's also pricing in the growing likelihood that some of this spills over into other markets. On Monday, US markets sold off and the Dow was down over 3% at one point. Again, this is a good sign. If you look back at January and February of 2020, when there was a lot of information about a different kind of contagion that was spreading from China, markets were shrugging it off. They didn't care. Every day a new all-time high. When markets are making all-time highs at the same time as there's bad news of potential market impacts, you're just setting yourself up for further failure later on. And then finally, the last piece of good news is again the Federal Reserve, because right now they have a huge gift handed to them by China, because they do not want to slow their asset purchases. They know how fragile this economic recovery has been that they've just financially engineered with easy money. And they know the moment they start to pull back on that easy money, they could very easily trigger an unwind of all that engineered fake growth that we've had over the last year. So they want to avoid that at all costs. And given the market impact across the world, in the United States and in Asia, that Evergrande and the unfolding situation has caused so far, this is a perfect opportunity for the Federal Reserve to just say, hey, we're not going to taper anytime soon. They could cite a number of reasons: broader market risks, financial stability, potential contagion, anything. So more than likely, I think when they have their press conference after they meet this week, they will announce, we're just going to delay the taper at least a little bit longer. The other thing that gives them room to continue their easy money policy even more is that this economic contraction coming out of China actually relieves some of the pricing pressure that the Federal Reserve has been feeling recently. You see a freeing up of resources as especially property development, real estate development in China has used so many physical real resources over the last couple of decades. As that slows down and as those resources become available, abundance makes things cheaper, and so that relieves some of the pricing pressure on the states here. So you have more room for the Federal Reserve to increase their money printing, or to at least maintain it, and to not feel the same pricing impact from that as we would if China was just keeping on pace. So in summary, we are watching two things mainly: the Federal Reserve and the CCP. Number one, Evergrande is likely not getting a direct bailout. Capital injections into the economy? Sure. Bailouts of the banks if they need it? Sure. Evergrande? Unlikely. The extent of the economic damage in China will depend on how far Xi Jinping is willing to go with his efforts to reduce inequality, clamp down on moral hazard, as he tries to get that balancing act right between lowering inequality, which is going to push asset prices down, and potential unpopularity from a resulting economic contraction. And they may even have to resort to a currency devaluation. And the Federal Reserve is meeting this week, and I would say that we are more than likely to see them delay the taper. Now, it's very possible they taper anyway, and then they point fingers at China and blame them for the economic contraction, for the fall in asset prices, but I'm leaning more towards the likelihood that they will probably just use China as an excuse to keep on purchasing as many, if not more, assets as they are right now, and keeping up with that easy money policy. So it seems like out of China, they proclaim communism very loudly, but they're pushing free market forces, which is allowing failure to fail. And we're sitting over here proclaiming capitalism, and we have endless bailouts and free money and money printing as far as the eye can see. But the problem in China right now is a big one, and it will not be going away anytime soon, because a lot of the growth that they've engineered over the last couple of decades has contributed to a lot of inequality. And so if you have a push from the top down to rein in on the moral hazard, which has been a contributor to a lot of that growth, and clamp down on some of that inequality, you're going to have the potential to spark a destruction of all that wealth that you financially engineered over the last couple of decades. It's a tightrope to walk, and it shows why economic calculation is the primary reason why top-down and centrally planned economies tend to, long-term, do far worse than the opposite. Of course, I'm going to stay watching. I will keep you updated as this unfolds. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.